Hi, welcome to Wealthify You, the place where your financial progress is the priority. There are so many forces acting upon the global markets and the direction they are trending in that we as individuals have any control over. However, that does not mean we can't do anything and wait for the markets to go upwards. The market is constantly changing. This means that there are always opportunities to profit from it. In this video, we look at how you can profit off of a downward trending stock market. I know that can be confusing for a lot of you, but trust me, I'll make you understand it clearly. So stick around until the end of the video. The bad news is that there are no guarantees when or how quickly this will happen. The bad news is that it's difficult to know what to do in this kind of market. The good news is that the market will eventually recover. Another good news is that there are some things you can do to protect your portfolio from a bear market, and also it creates an opportunity for investors to buy at a cheaper price. Investors need to be aware that during these times, it can be difficult to find good stocks, and they will have to do their research before investing. The stock market may be in the process of rebounding, but it's important to be invested in the right assets so that when markets turn, you'll profit more. As investors, we should be aware of how bear markets can affect our investments. We should understand that the stock market is not always going up, and that they may see some declines in the future. Bear markets are not always bad for investors. In fact, they can be very profitable, because bear markets usually have very low stock prices for good companies. Investors may also be able to take advantage of bear market opportunities as the market enters a period of recovery and goes back up. They should be aware of the importance of diversifying their investments into several different asset classes. During a downturn, we should trim out the loss makers in which we don't believe in anymore and aggregate more of those assets which we believe will grow. To find stocks that are worth buying when the price is low, go with companies that have been around for a long time and have proven their worth over time. These companies are likely to weather the storm better than newer companies with less experience or capital. We may want to consider investing in a mutual fund or a stock index, because these are more predictable than individual stocks and have better returns. You don't want to buy all of your stocks at once, because if one company crashes during a falling market, it will drag down your other investments with it and cause you to lose money. Instead, gradually increase your investment in each company and wait until the volatility has passed before investing more. You should also be aware that sometimes a stock may look like a good investment, but actually be overvalued because people are betting on company doing well without thinking about what the true potential is. You might want to hold off on investing in it for now to see if the enthusiasm disappears. Loss harvesting is a technique for minimizing the impact of losses on one's portfolio, and it may be employed in conjunction with other strategies such as dollar cost averaging and rebalancing. In some cases, it can also reduce or eliminate short-term capital gains taxes. The term loss harvesting was coined by financial advisor Harold Evensky in 1985, and it has been endorsed by many high-profile investors such as Warren Buffett and Ray Dalio over the years. Loss harvesting is a strategy for reducing capital gains taxes by selling investments that have gone down in value and are making losses in our portfolio. A loss harvesting strategy can be used to reduce the tax liability of an investment portfolio when there is significant volatility. It can also be used to offset any realized capital gains. In order to harvest a loss, an investor would typically sell the loss-making asset and buy it back at similar cost. For example, if an investor owns shares of stock that has declined in value by 20%, they could sell their shares and purchase those shares at the same selling price just to record a loss in ledger. Loss harvesting is usually done when capital gains taxes are likely to be more than the cost of selling an asset. Investing in stocks with low volatility and high dividend yield is a good way to generate passive income. If you accumulate dividend-paying stocks at lower prices during a sinking market, the dividend yield will be extremely attractive. For example, if a stock was trading at $100 and was paying a dividend of $4 a year, that gives us a dividend yield of 4%. If the same stock is beaten in the down market, you could get it at, let's say, $50. If the company fundamentally does not get affected by the down market much and can get same profits, it will be able to pay out that same $4 dividend. This means we will be making 8% on our investment without even selling the assets. However, these stocks will have more consistent growth than volatile stocks, but will also be less likely to go up significantly in value. In order to make money on the stock market during this time of uncertainty, it's important to be patient and stay diversified across different industries, so you don't lose all your money if one sector takes a turn for the worse. Many financial planners advise investors to avoid buying stocks when the market is volatile, and to keep investments diversified across different sectors and regions, so that you're less likely to lose money. In case you haven't noticed, the all stock markets have been going up and down a lot over the last few years, which can be very frustrating for investors, because nobody is sure what's going to happen next. If you want to invest in stocks when the market is volatile, it's important to keep your investment diversified across different sectors and avoid investing in any one company too heavily. Investing in a single sector will usually not provide enough of a return to make up for the volatility of the stock market as a whole. Investing in short-term bonds to hedge against uncertainty about the future of the economy can be a good strategy in a down market. The sinking markets are the toughest periods for investors to witness. This is the time that can test the patience of a lot of investors. If you give up and exit your investments, you will be doing the worst thing to your finances. This is not the time to be a scared squirrel, but to be a courageous lion. This is the time when everyone is waiting on the sidelines, and those who take the right action will be rewarded exceptionally well. It'll take some time for the market to settle on more sensible levels and start the uptrend. When you invest in a good company during such times, don't expect overnight success. It may take time for a company to grow and develop enough of its product to be effective, so be patient and give it time. Consider whether the investment continues to serve your purpose and if losing money would be worth it in the short run. If so, stick with that investment moving forward. In conclusion, the stock market is not always going up, and we may see some declines, and bear markets are not always bad for investors. These are the times when we see very low stock prices for good companies. We should be rebalancing our portfolios, harvesting losses and diversifying the investments into several different asset classes, and be invested for a long run. Thank you for watching till the end, and please subscribe to our channel.